Hi, and welcome again to Hidden Truths. And today we have our host, Josh Barrow. Hi, Josh. How are you today?
I'm doing wonderful. How are you?
Wonderful. Great. So today we're going to speak about the dollar, right?
Yeah, the dollar. One of my colleagues and I were arguing about whether you should short the dollar. And so I thought I would just talk through that trade, whether that's a good idea, and some of the stats of how you do this kind of trade. I'll leave it. I want to start saying this is probably the most difficult trade in this business, and it's not done successfully very much.
So the first thing that I'd like you to talk about is the understanding the fiat currency. Can you address that?
Yeah, so fiat currency, basically the world is on fiat currency. Now in 71, prior to 71, we were still on the gold standard. Essentially the gold standard was a ratio of an ounce of gold to how many dollars they essentially printed. And in 71, Nixon got rid of that. And so your money essentially is backed by the full faith of our government economically and militarily. However you want to put that, but that's how our currency works. That's how everybody else's currency works. So when I talk about fiat currency, it's a relative game. How strong is your currency relative to somebody else's? You can see in the first chart here is that we show a year-to-date chart of performance. Now, negative performance against the dollar means that currency's up against our currency. So what you've seen is resource countries like Russia, Brazil, Australia, actually performing very well against the dollar, and trading countries, Japan and Germany, doing terrible against the dollar. So it is an interesting course of what's gone on essentially after Russia invaded Ukraine.
That's really interesting. How about the year-to-date returns of the major currencies?
Again, we've seen resource countries do much better than trading countries. And I think the Russian currency against the dollar is actually the best. The ruble has outperformed the dollar in the year to date, like by 10%, something right around there.
It looks like a lot of people are concerned about debt to GDP, concerned about the trade deficit, the inflation rates that are rampant, the real rates.
There's a theory of economics out there called Austrian Economics. Basically, the higher your debt level, the weaker your currency should be. Now, in theory, that sounds great, but in practice, it doesn't work quite like that. Now, I am a big advocate of Austrian theory, but with some caveats. If we look at this chart that we have, you can see that the US has about 130% debt to GDP. Russia is about 17, China is about 77, Japan, which is the model for the future, is 262% debt to GDP, and then Germany 70 and Brazil 91. When we're talking about dollar strength, there's a couple things that come into play. One, how much debt do you have to GDP? Two, how much inflation do you have, and where your rates are. So, i.e., real rates matter. And essentially, the closer you are to neutral, which is you basically take inflation and the current rate, and you subtract the two, and you get a number. So the closer you are to zero, typically means you want to long that currency. Essentially, their liquidity and how fast they're growing are in balance. When you see a big negative real return number there, we're way from neutral. Typically, you want to short that currency, go against that currency. If you look at the bottom of this chart, you can see all these countries. Currently, the US is at about -5%, Russia at -8%. Now, I question Russia's numbers a little bit because they have a really high inflation rate, and I just can't get my head around that number. So I don't know if that's real or not. China, people question China's numbers all the time, but China is fairly close to neutral at this point. Australia is pretty close to neutral. Japan is fairly close to neutral, which is strange. And Germany is about -6. And then Brazil is fairly close to neutral. And you can see a pattern there. Japan is an anomaly, but you can see a pattern of trading countries against resource countries. Resource countries tend to be closer to neutral. So when we talk about this, there's a couple other caveats that we need to talk about. Size of the economy. The larger your economy, the less likely you want to short that individual currency. You typically don't want to short the dollar. You probably don't want to short the yuan. And the EU is questionable, but it's been a strong currency since its invention. When we look at this, we're looking at a static picture here. So we looked at everything as it is today. Now, when we do this trade, we need to look forward and project economic growth forward. It's hardly likely that I'd want to be long yuan here with the effects of their economy right now, essentially COVID zero policy shutdowns, and them putting money into the economy. What will happen is that neutral rate will actually become negative as they put money into their economy. That being said, when I look at the United States, and I look at the CPI, I know my colleague spoke about the basing effect of the CPI numbers going forward here. So I would think the US, with everything it's currently doing, is actually closer to neutral than that number says, which would say I don't want to be short the US dollar. And that's probably where I would stand. I don't think I want to be short the US dollar. I think I could get away with it a little bit longer. I would watch to see if commodities rolled over. If the price of oil started coming down per barrel, I would want to get out of that short dollar trade. I think you're probably okay there until you see that. But again, in my world, that's too short of a trade. We're not a year plus, we're not 3 years out. I wouldn't want to be there. In fact, I'd probably want to be long the dollar once I saw the commodities complex roll over. I think that would probably be a better trade. Also, that being said, once the Chinese figure out their problems, I really do think the yuan is a strong currency and will be someplace you'll want to be over a fairly long period of time. Now, there's questions about whether they report real numbers, but just judging by the stuff I see here, I think that would be a successful trade over a 5 to 10 year period.
How is that relating to the basing effect of inflation?
So the basing effect of inflation, when we talk about real rates, we essentially take the inflation rate and subtract it from either the 10-year return or the current Fed funds return. And I have those two numbers there and you can see where they are. So in the US's case, if that 8.3% inflation came down to say 5% inflation or 4% inflation, it would change these real rates and we'd be close to neutral. Again, when you see a currency at neutral, if it has some growth projections in the future, it's not something you want to go against. When I say that, I do think the Fed, with what it's done, it's 50 basis point, 2 hikes coming up, plus the quantitative tightening, and the basing effect of inflation, the year-over-year numbers falling off as a comparison is more accurate than it was versus COVID period and the next year. You'll see us get back to neutral fairly quickly. If that happens, it's not something you want to go against, it's something you want to go long. Commodities have 2 problems right now. One problem being there was a supply shock that is somewhat null because all those supplies are coming out through China. But there's another effect, which is called speculation. There's a lot of money chasing return. And so a lot of money had gone into commodities chasing returns, one of the best trades this year. And as that money goes in, it causes the price of that commodity to ramp up. Now, is that true supply and demand? No. But you can't tell the difference because the Chicago Board of Trade doesn't tell you what the actual demand for delivery is versus the speculative demand. They would color their contracts, then we would know what the actual demand and can price appropriately. When I look at the commodities complex, I do think the pricing is poor. I think that everything is overpriced because of the speculation. I want to scream about this because essentially the speculation creates more inflation into the economy, which then slows everything down more quickly. If there wasn't so much speculation in commodities, what would the price really be? And what would you be paying at the pump? Not $6, I wouldn't think. It is important to think about that in terms of what we're dealing with. As we get back to the neutral effect, hopefully some of that money will come back out of the commodities market and go back into the equity market or even the bond market, as the returns will look better there than what they've gotten in the commodities market. Now, that being said, it's not a perfect game. I would think that food-related commodities would stay somewhat elevated, although I did see a chart that shows massive elevation against the actual resource supply of those commodities. Again, there's massive speculation in these things.
Is that impacting the way large US Treasury holders are shifting their gears or are changing their directions right now?
Again, the US economy is slowing, and one could say that we are in recession. Now, that's a little bit of a sketchy topic, but I will put it out there. We are in recession. The real question is how deep that recession is. Again, the commodities complex hasn't helped that. In fact, it's causing the recession to go deeper than it had to be. That being said, the Fed actually owns the most treasury bills. It wasn't always like that, but that's what they've done in COVID to essentially buy their own debt. Some people call that a debasement of the currency. That's essentially what it is, and we won't go too far in there. The next largest holder would be Japan, and then China, and then the UK. What I find interesting is that these people are offloading treasuries, not putting them on. That is a fact that our treasury curve has gone up really fast, the fastest in history in the first quarter. That hasn't helped treasury holders. It's essentially they've lost money on their holdings if they were buying in December. These countries tend to be long-term holders if they hold to maturity. You know, it hasn't helped Japan, but again, there's a chart, we have another chart in there that shows who owns our treasury debt. If we're owning our own treasury debt, that doesn't give me a lot of faith in the dollar that essentially we're buying our own debt. I would like to see our debt more spread out over many different countries and different holders. Mm-hmm. And so that is a problem with the dollar, but the beauty of the dollar is it's the reserve currency. And if there's any geopolitical events or tension, everybody runs to the dollar because it's a bastion of safety. And so it's what makes this trade hard. And so what happens is, boom, there's an event, everybody runs the dollar. You might have been short the dollar for the right reasons, but you just lost a bunch of money because there was a geopolitical event that you couldn't control.
It's always been like that. The dollar as the safe area, a safe zone.
When the UK was the reserve currency, they had the same effect. As long as we keep the reserve currency status, that effect will happen. That is what makes this trade very difficult.
Yeah. Global recession policies matter, obviously.
Global recession policies do matter. So how do you get out of a recession? Typically what happens is they'll liquefy the market. The Fed will lower interest rates and do that. There's a little trick here, and let me explain it to you. Say your real rate is -10. Nobody's there, but say your real rate is -10. And you point out to the market that you're about to go on a tightening policy and you start tightening. What happens is they rally your currency because you're doing the right thing. You're getting back to neutral. You're putting things back in equilibrium. And so they'll rally your currency. If we're in a recession, they'll want to do the opposite. They'll want to lower the rates to essentially inject money to grow the economy again. The Fed is stuck in a little bit of conundrum here. Inflation's a little bit high, but like I said, the basing effect will bring that number back. They're committed to 250-point increases here plus QT. That essentially puts us back to neutral. So there's a lot of talk about going after the 250 basis point hikes is to pause. That is smart. Okay, now the market hasn't figured all this out, especially the equity market. That is smart because, again, don't forget, the market still thinks that we're on an upward trajectory of inflation due to supply chains, and essentially the numbers haven't rolled over yet. But if you listen to their talk, especially the Fed talk, they're telling you it's peaked. They know something. They know how the equation works, and you'll see this basing effect, and essentially you'll see the inflation numbers starting to roll back down as you get a better comparison versus the COVID comparison. Your policies matter. Our currency rallied when they started saying they would tighten. Now it's starting to get weak because smart people see recession, and so they know they can't do that. And then there's a question whether they can fight inflation here, and if it's ingrained or not. And what's happened is that trade's actually been a decent trade. Now, like I said, I don't think it's going to be decent for very much longer. So, Jack, if you're listening to me, maybe you should look to get out of that position.
What is your view of the dollar long term?
Like I said, I think that it's really hard because what's hard about this is guessing at, and I say guessing at how deep this recession is going to be. I look at it as an equation of gas prices, a very simple way to look at it. If gas prices remain elevated above, I forget what they are nationally, but in local market above $6, in the LA market above $8. If they stay elevated for a long period of time, 3 months, 4 months, 6 months, the deeper the recession gets. If they come down at some point, because again, that oil is leaking into the market, the Russian oil in the market is just going through China. So here's why I don't get the pricing. So if the oil is going through China, the same amount of oil is on the market. And instead of selling it to Europe, they're selling it to China. And then China would stop buying from its sources, Saudi, and there'd be more Saudi oil on the market to take care of Europe. The supply hasn't really changed. There might have been a blip in terms of, hey, we have to move this oil from this market to this market. But supply chains work themselves out. That's why they exist that way, to move things around if there's demand. If the same amount of oil exists in the market, why are we paying $120 a barrel today? Essentially, it's behavior, it's speculation that, hey, it's going to go higher because people think these sanctions are working, and they're not. When I analyze everything, I still see the same amount of oil in the market. And the market's starting to see it because oil is now in backwardation. I explained that in the last video. Essentially, the forward pricing is way below the current pricing. In fact, if you go out, I think 3 or 4 years, the pricing is in the $60 to $40 range. I wouldn't think that oil would stay elevated very long, but the longer it stays elevated, the deeper this recession is going to be. We're all guessing about how deep that is, and the market hasn't started guessing yet. But when it does, we'll see another rundown in the equity market. Hopefully, we'll see the opposite in the bond market as they decouple, which they're supposed to do. And we'll see a rally in the bond market. And then when we see kind of trail off and the commodities indexes trail off or roll over, then we'll see rallies start occurring again in the equity market. It's just a waiting game here. You don't want to really be long equities because we know there's another leg down in the market as the market tries to predict how deep is that recession and adjust discount for that. That's a guessing game right now. Nobody really knows how deep.
Yeah, for sure. Lots of hidden truths in there, right, Josh?
I would hope so. I don't know how hidden it is. I was laughing. I was driving to work the other day and I was thinking about something about COVID and then looking backwards like, oh, that was so obvious. Why didn't I do that? Hindsight's 2020 and who knows what's going to happen in the future.
You say people have to weigh in and people have to be patient as well. What would you like to leave your viewers with today?
Neutral rates matter. The fact that the Fed isn't at neutral, that's a problem. In a perfect world, they would always be at neutral and they wouldn't mess with it. The Fed plays games in trying to stoke the economy and do these things. And maybe that's not the best way to do things, but that's the system we have. Why I might like the Austrian idea and the gold standard. We don't live in that world anymore, and you have to adjust to this hybrid system that we have that exists. And
great insight again today, Josh. Very helpful. Thank you very much.
Thank you.
If you want more information or if you want to view and listen to all the podcasts from Hidden Truths, you can go to hiddentruths.today and also make sure to subscribe to the channel so that you get informed each time a new podcast or a new video is published to our channels. Thank you again for watching and see you next time.